Meet Michael and Oliver, two individuals starting with identical financial profiles, $60,000 in savings and a $65,000 annual salary. Despite their similar beginnings, they choose vastly different paths to build wealth, driven by their unique philosophies on how money should grow over time. Michael is drawn to the tangible appeal of real estate. He decides to purchase a $300,000 rental property using significant financial leverage. By putting down his savings, Michael gains control of a large asset, hoping that rental income and property appreciation will accelerate his path to wealth. Meanwhile, Oliver takes the passive route. He chooses the seemingly boring path of investing in total stock market index funds with consistent monthly contributions. Initially, Michael thrives on the excitement of being a landlord. He enjoys the process of collecting rent checks and watching his equity grow each month. Oliver, on the other hand, experiences the quiet, often invisible fluctuations of the broader stock market, trusting in the long-term power of compounding returns. However, the reality of real estate soon sets in. Michael begins to face the hidden costs of property ownership that often go overlooked at first. Taxes, insurance premiums, unexpected maintenance repairs, and periods of vacancy start to mount, significantly eroding the cash flow he once found so promising. Michael finds himself dealing with the labor-intensive demands of property management, from fixing leaky pipes to managing difficult tenant turnover and legal issues. He also faces the concentration risk of holding his entire investment in a single asset, leaving him vulnerable to localized market shifts or property damage. Conversely, Oliver benefits from the simplicity of a highly diversified portfolio. His investments grow steadily without requiring his time, active intervention, or manual labor. While Michael is busy managing his property, Oliver remains detached from the daily grind, allowing his index funds to compound quietly in the background. This initial divergence highlights the fundamental trade-off between the active, hands-on control of real estate and the passive, automated efficiency of the stock market. As we move into year 3, the financial picture begins to clarify. Michael has collected substantial rent, but his net cash flow is surprisingly thin. The cumulative weight of property taxes, insurance, and inevitable repairs like a failing water heater or roof leak drains much of his rental income. When Michael accounts for every dollar spent on maintenance and vacancy, his actual cash flow is far lower than the gross rent checks suggest. Meanwhile, Oliver's brokerage account has been quietly working. His consistent monthly contributions, paired with market growth, have built a solid, liquid foundation. While Michael's money is locked into a single physical building, Oliver's capital is spread across thousands of companies, capturing global economic growth. Michael still holds the advantage of leverage, as his mortgage allows him to control a $300,000 asset with only $60,000 down. This leverage amplifies his gains as the property appreciates, but it also amplifies his risks, as he remains responsible for the debt regardless of performance. Many investors focus solely on the rent check, ignoring that real estate is essentially a small business that requires constant capital reinvestment. By year 5, Michael is deep in the trenches of property management, handling plumbing emergencies, and the logistical nightmare of finding new tenants. His rent has increased over time, but so have his overhead costs, keeping his cash-on-cash return in a modest, single-digit percentage range. Oliver, however, continues his disciplined approach. His portfolio is now large enough that market fluctuations create larger dollar value swings, yet he stays the course. The beauty of the index fund strategy is its lack of friction. Oliver doesn't have to worry about roof replacements or bad tenants during market dips. By year 7, the compounding effect in Oliver's account begins to accelerate as his previous gains start generating their own returns. This is the snowball effect of long-term investing, where the sheer size of the principal begins to do the heavy lifting for the investor. Michael's property has also appreciated significantly, and his mortgage balance has steadily declined, slowly building his net worth through forced savings. Yet, Michael's wealth remains tied to the local real estate market, whereas Oliver's wealth is tied to the broader, more resilient global economy. By year 10, the two investors find their net worths surprisingly close, despite their vastly different daily experiences and levels of effort. Michael has built equity, but he has also spent hundreds of hours managing his asset and carrying the stress of debt and maintenance. Oliver, conversely, has spent almost zero time managing his investments, enjoying the freedom that true passive income provides to his daily life. The separation between these two paths becomes more pronounced over the following decade as the power of compounding truly takes hold. By year 20, Michael's mortgage is nearly paid off, and his property value has climbed, providing him with a significant, albeit illiquid, asset. Oliver's portfolio, bolstered by 2 decades of consistent contributions and market growth, has reached a similar, yet fully liquid valuation. Both men have arrived at a similar financial destination, but their journeys have demanded very different things from their time and mental energy. Michael's path was defined by debt, physical maintenance, and the complexities of being a landlord, which limited his flexibility and liquidity. Oliver's path was defined by market volatility, but he maintained total control over his capital, allowing him to pivot or access funds if needed. It is also worth noting that contribution size is a major variable. Had Oliver increased his monthly savings, his growth would have far outpaced Michael. In the stock market, increasing your investment is as simple as changing a recurring transfer. In real estate, it requires buying another property. This makes scaling in real estate significantly more complex, as each new property brings a new set of maintenance, tax, and management challenges. Of course, stocks are not without their own risks. Market crashes can be psychologically brutal, often leading investors to panic and sell at the bottom. Unlike real estate, index funds do not provide the immediate, tangible cash flow that many investors crave for their monthly budgets. However, real estate investors often fail to account for the hidden costs of ownership, which can easily turn a profitable deal into a burden. Vacancy, major system replacements, and property management fees are not just possibilities, they are mathematical certainties over a long enough timeline. Real estate can certainly outperform in specific scenarios, such as through house hacking or tax-advantaged exchanges, but these require specialized knowledge. The key takeaway is that real estate is not a get-rich-quick scheme. It is a business that requires professional-level attention to detail. Michael believed real estate was the ultimate path, while Oliver trusted the market to do the work. Both were right in their own ways. The real mistake is not choosing one asset class over the other, but rather making that choice based on incomplete information or social media hype. Too many people enter real estate because they see a rent check without looking at the repair bill that inevitably follows it. Similarly, many avoid the stock market because they fear volatility, ignoring the historical evidence that time in the market beats timing the market. Before deciding on your strategy, you must run the numbers for your specific situation, including every tax, insurance premium, and maintenance cost. Ask yourself, are you looking for an investment, or are you looking for a second job that happens to involve property ownership? If you want true passivity, the stock market offers a clear, evidence-based path that requires little more than discipline and time. If you enjoy the hands-on nature of business and want to leverage debt to grow your net worth, real estate can be a powerful tool. But never let someone tell you one is objectively better without asking them if they have included all the hidden costs in their calculation. The answer that includes everything, the taxes, the maintenance, the time, and the risk, is the only answer that truly matters for your future. Your financial journey is yours alone, and the best path is the one you understand well enough to stick with through the inevitable ups and downs. By looking past the surface-level narratives, you can make an informed decision that aligns with your goals, your risk tolerance, and your lifestyle. As the decades pass, the financial outcomes for both Michael and Oliver begin to converge into a surprisingly similar ballpark. By year 20, Michael has successfully navigated the relentless stresses of debt, major repairs, and constant tenant turnover to build wealth. His net worth has grown significantly, but it came at the cost of his personal time, energy, and the heavy burden of management. Meanwhile, Oliver has achieved a comparable financial result through the quiet, consistent, and low-effort path of long-term market participation. This comparison reveals that while real estate offers unique advantages like leverage and tax benefits, it is far more complex than expected. Conversely, index funds provide incredible liquidity and ease, but they require the iron discipline to withstand market volatility without any panic. Ultimately, this story illustrates that neither path is inherently superior. The real mistake is choosing a strategy based on superficial narratives. True success requires looking past the headlines to account for every hidden cost, risk, and personal commitment involved in your chosen path. Whether you choose the hands-on world of property or the passive power of compounding, your strategy must align with your actual life. By understanding the true nature of your investments, you can move beyond the hype and build sustainable wealth for the long term. Financial freedom is not about picking the trendiest asset, but about choosing the path you can realistically sustain for 20 years. Choose wisely, stay the course, and remember that the best investment is the one you can stick with through every market cycle. Let us look closer at the 20-year mark, where the compounding effect finally begins to show its true exponential power. Michael's property, once a modest investment, has appreciated steadily, reflecting the general growth of the local housing market over decades. However, that growth was not free. It was paid for with weekends spent fixing leaks, painting walls, and managing difficult tenant relationships. Every dollar of equity he gained was earned through the sweat of his brow and the constant vigilance required of a landlord. Oliver, on the other hand, spent those same 20 years living his life without ever worrying about a broken furnace or a vacancy. His index fund portfolio grew silently in the background, fueled by the collective productivity of thousands of the world's largest companies. He didn't need to be an expert in real estate law or plumbing. He simply needed the patience to let the market work. When we compare the final numbers, we see that both men arrived at a similar financial destination through very different routes. Michael's path was one of active business management, requiring him to treat his rental property like a part-time job. Oliver's path was one of passive accumulation, requiring him to treat his brokerage account like a long-term savings vehicle. The lesson here is that the smarter choice is often the one that best fits your personal temperament and lifestyle goals. If you enjoy the control and tangibility of real estate, the extra effort might be a price you are happy to pay. But if you value your time and prefer a hands-off approach, the stock market offers a proven way to build significant wealth. Many investors fail because they try to mimic someone else's strategy without considering the hidden costs of that specific approach. They see the rent checks but ignore the roof repairs, or they see the market gains but panic during the inevitable downturns. Wealth building is a marathon, not a sprint, and the most important factor is your ability to stay in the game. If a strategy causes you too much stress, you are likely to abandon it before you ever reach the finish line. Consistency is the secret ingredient that turns small, regular contributions into a massive financial foundation over the course of decades. Whether you are buying properties or buying index funds, the math only works if you keep contributing and keep holding. Michael had to deal with the reality of debt, which amplified his gains but also increased his personal financial risk profile. Oliver maintained full liquidity, meaning he could access his money if an emergency arose, unlike Michael's tied-up equity. This liquidity is a massive, often overlooked benefit of the stock market that provides peace of mind during uncertain times. Yet, real estate investors often point to the ability to force appreciation through renovations as a way to beat the market. Both arguments have merit, but they apply to different types of investors with different levels of experience and available time. The key is to run your own numbers, accounting for every tax, insurance premium, maintenance cost, and potential vacancy period. Don't rely on the best-case scenario projected by social media influencers who often leave out the messy reality of ownership. Real estate can be a powerful wealth-building tool, but it is a business, and it should be treated with professional seriousness. Similarly, the stock market is not a get-rich-quick scheme. It is a slow and steady engine of global economic growth. When you look at the 20-year horizon, the differences in net worth become less about the asset and more about the investor. It is about the discipline to keep investing even when the market is down or when the property is vacant. It is about the wisdom to ignore the noise and focus on the long-term trends that actually move the needle. Most people spend more time planning their next vacation than they do planning their long-term financial strategy for retirement. By taking the time to understand these two paths, you are already ahead of the vast majority of individual investors. You now know that real estate offers leverage, while stocks offer liquidity and ease of management for the average person. You know that both require a commitment to long-term growth and the ability to weather the inevitable storms of life. The next time you hear someone claim that one path is definitively better, remember the stories of Michael and Oliver. Ask yourself what kind of investor you want to be: the active manager or the passive participant in global growth. There is no wrong answer, provided you are honest with yourself about the work required to achieve your financial goals. Your journey to wealth is personal, and it should reflect your unique values, your risk tolerance, and your available time. Don't let the simplicity of a headline distract you from the complexity of building a real, sustainable financial future. Take the time to run the numbers for your own situation, including every hidden cost and every potential tax advantage. The clarity you gain from doing this work is the most valuable asset you can bring to your investment strategy. It will give you the confidence to stick with your plan when others are panicking or chasing the latest trend. Building wealth is a quiet, often boring process that happens over years of consistent, disciplined, and informed decision-making. Embrace the process, stay focused on your long-term objectives, and trust in the power of your chosen financial path. The future belongs to those who prepare for it today with a clear head and a well-thought-out plan of action. Whatever path you choose, make sure it is one that you can walk with confidence for the next 20 years. Your future self will thank you for the diligence and care you put into these decisions right now.